So I think from a timing perspective, we're getting into a time where the market is ripe for a top. My extreme upside target that I've been in has been in focus for the last 3 to 6 months was that maybe crude could get back to the $96 level. But I didn't expect it to go any higher than that. And that, like I said, is a real extreme if the perfect combination of factors were to take hold. But my main upside objective right now is right around the $88 to $90 level.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. It's 9/13/23, and well, market's kind of been zigzagging a little bit. What's going to happen next? Let's talk with our good friend, Eric Hadik. You find him at, Inside with 2 I's, InsiideTrackTrading, track.com. And Eric, it's great to have you back on. Hey, first, what's your main URL for those of you out there who want to check out Eric's work out?
Well, thanks for having me back, Kerry. And the main URL is InsiideTrackTrading.com. So like you said, inside with that extra I in the middle, InsiideTrackTrading, tracktrading.com.
All right. And the link to that's in the show notes on this interview on financialsurvivalnetwork.com. While you're there, sign up for your free newsletter. If you got any questions for Eric or myself, we really want to hear from you. Shoot me an email, kl@kerrylutz.com. So, Eric, when we last spoke, you weren't very optimistic about the stock indexes. Anything changed?
Well, it all depends on what perspective you're talking about. I think that in general, stocks are still going through a multi-year topping process. So from that perspective, I'm not overly bullish. Coming into this year, we had a host of 3 to 6 months, 6 to 12 month cycles that were bottoming out at the beginning of the year and completing what I thought would be the first significant sell-off in equities. We got that in January and kind of reinforced it in the months that followed. Since then, we've seen a lot of two-sided trading in many of the indexes. I think one of the timeframes that I was warning listeners and readers about was from late July into mid to late August. You had kind of a negative cycle when you could see some selling. We got that pretty much on schedule. And now you're in a period where some of the indexes are poised to rally to newer highs on the year, whereas others are showing continuing weakness, for lack of a better term. It's not weakness as if it's about to fall apart, but on a relative basis, I think one of the really interesting indexes, if you look at the Russell 2000 over the last couple of years, and particularly this rebound from June and or September of the last year when it set a double bottom, that index was able to recover enough to neutralize some of its negative trends, but not turn them up. And at the same time, you have some long-term averages and other indicators rolling over and starting to turn negative on an even broader perspective. And so that index gives a much different perspective than some of your stronger indexes like the NASDAQ 100. But I think that early 2024 is is when we enter another period where there's a higher probability for a new sell-off in stocks. So that's kind of my time horizon, and to quantify bullish or bearish on the stocks, it comes down to which time frame you're talking about within there. Right now, I think that stocks could see a little more upside. I think you're going to see a couple of sell-offs between now and year end, but equally so, some intervening rallies until we get to that early 2024 timeframe. So more two-sided action than anything.
Okay. And one thing we've seen is interest rates. The Fed has continued to hike. Is that trend going to continue?
I think that not only my work, but the general consensus is showing that it's time for a halt in that. Now, whether they're going to drop them as aggressively in 2024 as many of the traders and economists were expecting and were projecting, that I think is starting to come into question. Whereas, there was talk of, I think, 4 or 5 rate cuts next year. Now it's talk of maybe 3. And so you get that perception that drives the market and future perception. So whether they raise rates again at any point in the near future, which I think is becoming less and less likely, traders are already looking ahead to what they expect for the first part of 2024. And I think, once again, I probably sound like a broken record with this, but that 4-year cycle in bonds and notes has been just uncanny in its accuracy, and it helped pinpoint the July 2020 peak in bonds and notes, which was a corresponding low in interest rates. Prior to that, it had set a previous peak in July of 2016, and prior to that in July, August of 2012. And I think that same cycle, along with many corroborating cycles, is saying to look for a rebound peak in bonds and notes in around July of 2024. That would mean a corresponding low after a dip in interest rates at that same time. So from not only that cycle, that's just something that I use as a backdrop, but from a lot of other timing indicators I have, my work still shows that we see the initial upswing in interest rates into the current time frame. Then you see kind of a plateau or a topping phase. Then you should get a brief dip in rates in first quarter and second quarter of next year. But after that, I think things will get even more interesting heading into late 2024 and then into 2025.
Okay. So, one thing with interest rates, housing, very interest rate sensitive. And yet, over the past couple of months, we've seen the home builders, the big publicly traded home builders like Lennar, Pulte, Toll Brothers, hit all-time highs during that time. Now they're about 5 to 10% off their peak. Can we glean anything from that?
I think you can glean that they're doing things more efficiently and generating profits more. And you go back to the beginning of COVID and the different things that have shifted with home building, first starting with the escalation in raw resources prices when lumber quadrupled and quintupled in price and other resources just shot through the roof, and you had labor shortage. You found a lot of these home builders go about their construction a lot more prudently. And even though there's a burgeoning demand for homes, they're not building near as quickly or as haphazardly as they've done in past cycles. So yes, that's helping the bottom line. but it's also extending this overly elevated price in homes because the supply is not there. And anyone who previously had thought about selling a home and either upgrading or downsizing, they can't stand the thought of trading in a 3% mortgage and having to take out a 6% mortgage. So they're just not, so the supply that normally would be there in a normal real estate cycle is not there. So it's artificially driving up the price of homes. And you could, out in the foreseeable future, get one of these little bit of a domino effect where you get rates start to come down a little bit, you get more people selling homes, you get the builders willing to commit a little bit more, and then you get prices start to come down, and that creates its own reality moving forward. So the stocks of those home builders, I think, is a reflection of some things that have gone on the last year or two, but I don't know if they have a lot of future prognosticating effects in those elevated prices of their stock.
All right, we can see that. There are definitely other things besides interest rates that dictate home demand and supply, and the fact that nobody wants to get out of their low-rate mortgages to go downsize and wind up paying more per month than they were before is definitely one of those trends. All right, so oil, you were calling for higher prices. We're now at the highs of 2023. Do we go higher? Do we break 100?
I have been all along looking at the time frame that we're now coming into. For the last 3 months, I just kept repeatedly saying crude and the products should head higher into middle of September. And that's when some of my initial cycles would begin to peak. But from an even broader perspective, you've got a fairly consistent 5-year cycle, and that's also the midpoint of the broader 10-year cycle, all of which are arguing for a peak here in the September-October timeframe. So I think from a timing perspective, we're getting into a time where the market is ripe for a top. My extreme upside target that I've been has been in focus for the last 3 to 6 months was that maybe crude could get back to the $96 level. But I didn't expect it to go any higher than that. And that, like I said, is a real extreme if the perfect combination of factors were to take hold. But my main upside objective right now is right around the $88 to $90 level, where I think that crude should run into a lot of resistance.
Okay, so when we talk about crude, we also often look at nat gas, which has been trading lower since earlier in the year when it was, or last summer when it was at $10 per MCF.
Yeah, natural gas certainly crashed in price as our supply continued to increase. And it's been in what I believe is a bottoming phase. In early June, it set an initial bottom and has held that ever since. That was really when a lot of multi-month and 1 to 2 year cycles were anticipating a bottom. But there's been a fairly consistent 3-month swing type of cycle in natural gas, going from highs to highs, then highs to lows. And that initially bottomed in early June, but then it showed that we should see a secondary low in early September, and we're just coming through that. So I think that natural gas is building a base, but there still is some time before some key indicators would be able to start to turn more positive and project more of a sustained and substantial rally. So I think we're still in this basing period, and there's a couple of key factors I need to see kick in before I think that natural gas could really sustain an up move.
What about gold? Precious metals.
Yeah, gold is still, I know when we talked last time, first of all, we were kind of reviewing the discussion from the previous time that gold really had a very significant cycle top in early May, and I didn't expect it to see another comparable high until early November. And in between, when we talked back in June, I think gold still had some more downside potential before it would begin a more significant rally. And for 4 or 5 months, I just kept my readers focused on the middle half of August as the time when the next cycle low in gold should take hold. And that is pretty much what we've seen. Both the metals and the mining shares all headed steadily lower from the early May cycle highs into August 17th to the 21st, which was the ideal time for a bottom. Based on monthly, weekly, daily cycles, there's a very consistent 23-week cycle in gold in the XAU index. And once again, those markets bottomed in lockstep with that cycle in the latter part of August. So we're in the weeks following that cycle low, starting to build a little bit of a higher base, higher plateau. And I have said all along that I thought the bullish phase, moderately bullish phase for gold would not arrive until the second half of September, first half of October. And that, like I said, is just the beginning of when some of these timing indicators I follow would start to turn to the upside. My focus or my warning has been all along that very often gold will see the majority of its move in just the final weeks prior to a cycle high. So if I'm looking for a cycle high in early November, that means really the weeks leading into that through October are the time when you often would see a stronger rally. So that kind of fits with these indicators starting to turn positive or having the potential to turn positive in second half of September, more likely in the first half of October. And so I think we could get a nice intermediate rally there. But gold is still going to have some headwinds working against it until we get past early 2024.
Okay. And finally, what about the dollar?
The dollar is one of those headwinds that I think is keeping gold intact. And I believe that the dollar set an initial bottom this year, but that was just the first sell-off that we will see in the dollar. Throughout this year, I've been devoting a decent amount of my monthly newsletter and the opening comments and analysis to this thinking that I have that we have entered a new 40-year cycle of currency wars, and I explain that in more detail in my publications. But that one of the key things within that long-term cycle is a transition for the dollar. And I think that we are just in the very, very early stages of that. And my intermediate work is showing that the dollar should rebound from mid-July when 3 to 6 month cycles bottomed into January of 2024. But at that point, I'm looking for a secondary, a lower high in the dollar. And then things start to get a little more negative for the dollar in the 1 to 2 years that follow that time frame. And that's when I think you'll also see more of an opportunity for gold and for other anti-dollar type of vehicles. So I think the dollar is in this phase of tracing out a long time major top. But again, we're talking multi-year type of cycles and trends. So it doesn't all happen at once. It doesn't mean that the dollar suddenly collapses in 6 or 12 months. It means that it's going through a longer term transition phase. And I've laid out a lot of the reasons, fundamental and technical, but you certainly saw another affirmation, another duck lining up in a row in late August when the BRICS nations had their annual meeting and announced that they were inviting Saudi Arabia and I believe 5 other countries to join BRICS. And these are all countries that want to get out from under the U.S. dollar supremacy and being forced to use the U.S. dollar for a lot of their trade. And it's a slow, steady process, but it's looking to break that hegemony of the U.S. dollar. And over the coming years, I think you're going to see steady movement in that direction. And there will be key times within that when the dollar suffers some reactive sell-offs as this topping process continues to unfold.
All right. So if I remember correctly, you were kind of called the election based on the strength of the dollar last time. The dollar usually goes higher during Democratic presidencies and lower during Republican presidencies. Do you think this is maybe predictive here?
At this point, I don't see that. I don't see as clear of an indication. Last time in the 6-8 months heading into the election, it was looking very clear that the dollar should bottom and begin a new multi-year rally, which, yes, as I described, has been very consistent in Democratic administrations. With the dollar going through this topping process, it's going to have as much of a determining factor on whether we see several years of two-sided type of action as that whole transition unfolds, or whether we see a really sharp sell-off looking into, say, 2025, which would be the first year of a new administration. It certainly could have that precursor nuance to it. And I'll be looking at that more closely coming into next year. But right now, I don't see strong enough evidence to go one way or the other in that.
Okay, interesting. And any other markets we should be looking at where you're seeing trends shift or perhaps exacerbate?
I don't know that there's any that really stand out right now. I've been looking at one particular grain, the wheat market, to set a bottom in here, but that could take some time before it starts to build a base. Been looking at cryptos, Bitcoin, etc., as having a negative cycle from mid-July when intermediate cycles peaked, stretching out into November when I anticipate the next significant bottom. But in both of those cases, that means you've got the potential for a lot of two-sided trading, 1 to 2 week trends in each direction. So that needs to be kind of focused on in a more microscopic perspective as opposed to a broad perspective.
All right. So interesting times ahead. Sounds like there's going to be a lot of volatility and a lot of uncertainty in the world.
Yeah, I think there's definitely the potential for a couple black swan events over the next year or so, especially based on how some of the markets are lining up. But you can't really plan for them per se, other than just making sure you're adhering to good, strong money management principles and following the trends, because usually those future events cast their shadows before.
All right. Well, hey, appreciate you coming on and sharing your view of the future with us. Can you just tell us again your site, where we find you, how we subscribe?
Yes, you can go to InsiideTrackTrading.com, inside with the extra I in the middle, so it's INSIIDE, tracktrading.com, and you can find many archived reports, newsletters, samples, and also information on subscription packages.
All right, excellent. Hey, if you got a question for Eric or myself, please just send me an email, kl@kerrylutz.com. We'll get you an answer as quick as we can. And while you're at it, you'll find the link in the show notes to this interview on financialsurvivalnetwork.com. Just click it, take you right to Eric's site. And while you're there, sign up for your free newsletter. Eric, always a pleasure. Great to have you back on. We're going to be watching your forecast closely and see what happens next.
Thanks for having me back, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.